The CNIB National Youth Council presents Let's Talk Money. Part 1, Banking Basics.
All right, so while we're figuring out the screen sharing, I'm just gonna go ahead and introduce our first speaker. So like we said, this is a 6-session series. And to start us off, we have Nibal Yamout. I'm sorry if I didn't pronounce that correctly, but Nibal is from Royal Bank of Canada, so RBC. She is a regional manager and a mortgage specialist located in Edmonton. And today she will be presenting about banking basics. So how to get started in terms of setting up bank accounts. And the floor is now yours, Nibal. Thank you so much for being here.
Awesome. Thank you so much. I'm turning my camera just for 2 seconds so you guys can see me. And I'm going to turn it off for the presentation. But thank you so much for joining, everybody. I'm so excited to be here just to kind of help you understand the basic of banking. I'm glad that this series is going to take on, multiple meetings after to help you build yourself and set yourself up for success, because there's definitely a lot of information for you guys to know and understand and be prepared for the future. So I'm going to turn off my camera now. And what we're going to do today is talk about the basics. So the basics are bank accounts and credit cards and loans, line of credits. These are the things that we're just going to quickly talk about today. And at the end, we'll open it up for any questions. And even if it's outside the basic banking, I'll try to answer as much as I can. If we go to the next slide, and maybe a little bit about me, I am a regional manager, mortgage specialist in the Edmonton area, but I have been with the bank for about 6.5 years, and I've done so many roles. In the beginning, I've been in a sales role where I have been an advisor to help clients with their basic banking. So this is what we're going to be talking about today. And I've done, other leadership role, assistant branch manager, and now regional manager. So this presentation has 2 parts. The first part, we're going to talk about bank accounts and how to help you understand what bank accounts are for. How do you use your card, the ATM, your online banking, and all of those things. And then the second part will be about, credit cards, how to build your credit, and what does that look like for you. So if we go to the next slide, for a bank account itself, there's 2 types of bank accounts. There's a checking account for your everyday use, and that will be your primary account. And then the savings account is the account where you're going to put money that you don't need for your day-to-day expense. So usually the savings account will have a higher interest rate where you can accumulate interest on your money the more you keep it in there. So that account is really intended for you to put your money in, try to forget about it, and save as much as you can.
Nibal, can you explain just a little bit real quick what exactly the interest rates are? And how
yes. So right now, and it depends on the year and depends on what Bank of Canada decides to do. But right now we're at the lowest interest rate environment. So our interest rates on savings account are anywhere between 0.2 and 0.7%, which is very, very low compared to, for example, last year, we were at 2.5%, for example. And really that depends on the economy, the environment, and what banks decide that those rates are for. So they can easily fluctuate from year to year. But again, it's always good for you guys to always have a savings account, to put that money on the side, and really leave it for emergency. If you're looking to now get more sums of money, put in money that you're not going to use for a little while, then investing would be a better opportunity for you guys. And I'm sure you guys will talk about that in any of your other sessions around, what good investing is for, how much interest or return can you accumulate on your investments. So in order to open a bank account, all we need to do is, you go to the bank, or now we do everything over the phone or via video like we're doing this today, is just have a photo ID, proof of address, and if you're a student, a proof of your student status, because as a student, most of the time your bank accounts are free. That's really a promotion that we have for student banking in order to help you save as much money as possible. As we know, when you're going through school, you do have lots of expenses. So if you go to the next slide, then we have two types of cards. So you're going to have your debit card and your credit card. I'm going to talk a little bit about the credit card, but I'm going to leave it to the second part of the presentation as well, because we're going to go into more details. So when you open your bank account, you're automatically going to be given a debit card that will help you identify yourself as a client. So you go to the bank with your debit card, they're able to identify you. And then this is where, you select a 4-digit PIN unique to you, where, you present your card, they identify you, and now they know it's you. Same thing, if you're using your debit card, you go to the store to purchase, you're going to have to enter those 4-digit PINs. That's going to help you make the purchase. So that debit card is automatically linked to your checking account. So any purchases that you make, that money will be taken directly from your account automatically, whether you're coming to the branch to paying a bill, transferring funds, or whatever it is. You're going to the ATM to withdraw money, or you're going to the store to make any type of purchases. Now, the credit card is more commonly used for your everyday purchases, especially online, now that everything is done online, or if you're, let's say, renting a car, or booking a hotel room, or whatever the situation may be. Most of the vendors, they prefer you using a credit card versus a debit card. So also a credit card is one of the best way to help you start building your credit history, and we're going to go through it a little bit more later on, but it's really, really important to have a good credit history. So basically, your credit history is your financial reputation. It's a picture on how well you manage your money, whether you're paying bills on time or you're paying your outstanding debts on time. And then if you've missed a payment, this is where it might affect you negatively. And again, we'll talk a little bit more about that. So if we go to the next slide, now we're going to talk a little bit about how you can access your money. So obviously with COVID, we're not doing things face-to-face. We're not going to the bank as often. So it's good to have access to our digital platform to be able to do transactions. So for those of you who have bank accounts, you can directly log into your online banking and complete transactions. Like, again, paying bills, transferring funds, sending money to your friend, or whatever that situation may be. Same thing with your mobile banking. So usually the online banking and the mobile banking on your phone, you can basically do the same functions. ATMs are mostly used to, again, taking out cash. And then we have the telephone banking. So if for whatever reason you don't have a phone, you don't have a laptop, you can just give us a call on our customer service, and they can do that over the phone for you. I do see in the chat that there's a question. Did you want me to wait until the end to respond?
Yeah, I think if you can hold off, we'll take care of the questions in the discussion, if that's okay.
That's perfect. And then if we go to the next slide now, we're really going to talk about credit and how getting a good credit is important, and how to build that good credit, because it's going to help you with everything that you're going to need in the future. So it's going to help you with purchasing your house, buying a car, getting student loans, whatever it's important to you, it's going to help you get there. If we go to the next slide, we're going to talk about 3 things. So I'm going to explain what a credit is. I'm going to explain how you can get a credit. And then the third part is going to be how to build a good credit and very good credit habits, because that's really what's important. And that's how the credit really defines that personality that you have in terms of lending. So that's where, the banks or anybody that's going to give you any sort of credit cards or loans, they're going to look at your history. So if we go to the next slide here, so if we want to define what a credit is, credit in the simplest form is a way to borrow money. So it's your ability to get something before paying for it on the promise that you have to pay it back in the future. So in the beginning of the presentation, we talked about debit cards and credit cards. So debit cards, that money is taken directly from your account, versus the credit piece, you're borrowing that money and promising to repay it in the future. And we're going to talk a little bit more about that. So if we go to the next slide, we have 3 players. We have, if we click, sorry, yeah, there you go, sorry. So we have our borrowers. So the borrowers are the person who's receiving the money. Sorry, my dogs are barking now. So the borrowers are the people who are receiving the money. So it's you. You need some money, you're the borrower. The lender is the person who's willing to give you that money. So whether it's a bank, a car dealership, or if you go to Walmart and getting a credit card, for example, these are the lenders. And the principal is the amount that you borrow. So we're going to go through a little bit of a scenario. So let's say that you have a friend and they ask you for money. So they ask you for $15 to borrow. Let's go through some of the factors that you need to think about before giving that money away. So if we go to the next slide. Okay, so the first thing you want to ask yourself is, do you have that extra money to be able to lend it to somebody? Is this person trustworthy? Are they going to keep their promises to pay? Do they have money coming in to be able to pay it back? When will I get my money back? In a few days, in a few weeks? And then, think about it. That $15, am I going to need it urgently, or it's okay if my friend never pays me back? Now think about the $500, because that's a completely different story versus the $15. You might want your $500 back in a week, for example. And what if your friend doesn't pay you back? How are you going to react to that? Now think about $5,000 or $500,000. So these are some of the things that the lenders think about when they are giving that money to you. So the lower the amount, obviously the lower the risk. But then when we're giving you higher amount, this is where the risks are involved. And this is where, all those questions are going to be asked before we determine if we want to give you that money. So if we go to the next slide, and we're going to talk a little bit about interest. So why do we charge interest when we're borrowing money? So lenders charge interest for that risk for lending that money. So we talked about the risk, $15 versus $500,000. That's the risk that the lender is willing to take to give you that money. But obviously, they're going to charge you interest, a percentage on that amount that they give you to help them with their risk. So there's always going to be risk, and there's always going to be a possibility that we're never going to pay that lender back. And that's what's so important. If we go to the next slide, and then this is where the credit score really plays into consideration, because people that have good credit score, their interest rate might be a little bit lower than people that have the people that have higher credit scores, so good credit ratings, their interest rate may be lower. And the people that have bad credit scores, their interest rate may be high because the risk of them paying back that debt may be higher. So the bank or the lender will have to charge an interest. So basically, once the lender gives you money, you have to pay it back. So the principal, which is the money that you borrowed, plus the interest, the total of that will have to be repaid. And we'll talk a little bit about what that looks like in terms of for how long, the payments and all of that. If we go to the next slide, This is an example of a credit card statement. Just a simple example of what that looks like. And if you see here in the circles are the three main things that you need to consider.
Hi there, Nibal.
Yes?
Hi, this is Thomas with the CNIB. I think maybe perhaps to be a bit more inclusive, do you mind describing what's on the screen for those who may not be able to see it?
Absolutely.
Thank you so much.
Yeah, for sure. So on the screen here, you're going to see a credit card statement. So on the credit card statement in front of me, I'm going to see the transaction, so the thing that I purchased throughout the month. I'm going to see my limits. So let's say for a credit card, I have here on the example, I have a $13,000 limit. Sorry, a $20,000 limit. And then I've used my balance on there is $13,000. So on a $20,000 limit, I used $13,000, and it shows there that I still have available credit, $6,000 approximately. So this is, again, my capacity to borrow more money. Obviously, the more money we borrow, the more we have to pay back, the more interest we're going to pay if we're unable to pay the full amount. But basically, that statement, and if some of you have credit cards, it really explains in details on everything you've done. And most of them are on your online banking or on your mobile banking, or some of them receive them by mail, paper statements. So depending on what your preference is. And at the end of the statement here, you're going to see your balance. So this person in front of me owes $13,451. On the side of it, it tells me the minimum payment and then the due date. So when I have to pay that bill. So on this one here, it tells me, or how it works is that if I pay $13,451 on July 27 on my credit card, I will not be charged interest, because that's how the credit card works. Now, if I don't have $13,000 to pay on my credit card, I can make a portion of that payment. So when I make a portion of that payment, the rest is going to be transferred into my new balance, and I'm going to be charged interest on it. So if for those of you who can see the statement, if you see annual interest rate purchases, 19.5%. So let's say I pay $10,000 on the credit card and there's $3,000 left on my balance, I'm going to be charged 19.5% on that $3,000 until I pay it. Okay, so that minimum payment piece, the $11 that you see on the screen, is the minimum that I have to pay. Now, if you don't want to be charged interest, I definitely don't recommend you paying $11, because now you're going to be charged almost 20% on $13,000, which is a huge amount. And that amount is calculated annually. So let's say, $13,000, you do $13,000 times 20%, that's going to give you your yearly interest rate divided by 12. It will tell you every month how much interest you have to pay. Okay, I'm going to leave it there. If you guys have questions, we can go back to that slide. But again, the first thing that you have to think about, and what's most important, is trying to pay off that balance as soon as the payment due date, so you don't get charged interest at all. If you go to the next slide, oh, there you go. I already talked about all of that. Perfect. So here are the donuts. But basically, we're going to talk in a little bit further around the choices that you can make in terms of credit cards. Because we have credit cards, and again, there's going to be a slide about that have lower interest rates than the other ones. There's cards that have reward points that are more attractive to other people. So we'll talk a little bit about that further. If you go to the next slide, I want to talk quickly about the three types of credits. So we have credit cards, and we've talked about that. Then we have personal loans and personal line of credits. Now, I'm going to explain those three in detail. So when we go to the next slide, we need to understand what we need. Yeah, so we can go to the next slide. So, what's the difference between a credit card, a credit line, and a loan? And how can I choose which one is better suited for me? So again, it really depends on what you're looking for, what's important to you, and how you're going to use it for that specific reason. So in terms of the credit card, and you can fill in all those things, yeah. So what are the purpose of a credit card? It's for smaller purchases or online purchases. So again, you want to pay your Netflix subscription, or you want to buy something on Amazon, you're going to need a credit card. You're going to go to the store and buy groceries, a credit card. So why do we say small purchases? Is obviously because of the interest rate. The interest rate on credit cards are high for a reason. It's because they're intended for smaller purchases. Because if you go buy a car with a credit card, then you won't be able to pay it back. And with 20% interest, for example, it's going to be a huge burden on your financial picture. So again, smaller purchases, online purchases, things that you can pay back quickly. Then we have, it depends on your situation, but most of the credit cards are not secured. That means, for example, if you want to get $1,000 credit card, the lender will give you that credit card for $1,000. What secured means is that you have to give the lender $1,000. They can put it aside and they'll give you a credit card. Once you don't want the credit card anymore, they'll give you the money back. Usually secured credit cards are mostly for people that have very, very bad credit and that need a credit card very badly. This is where, to help us with our risk. So again, we talked about risk, being super secure, where I have my $1,000, need the bank, I took the $1,000, I have it secure, and now I can give this person a credit for $1,000. And at the end here, you see payments. So like I talked on the detailed statement, the amount borrowed should be paid in full within 21 days of the purchase to avoid any interest. So again, if you pay the full balance at the due date, you're not going to be charged interest. But if you don't pay the full balance, this is where the interest is going to be charged. Okay, so if we go to the next slide and fill in, oh yeah, it's all there. So again, we talked about what's important to you because, as you know, there's so many cards. There's low interest rate, no annual fee cards. There's just low interest rate cards. There's, cards that give you travel insurance, rewards point, cash back. So again, it depends on what's important to you. And if you are looking to eventually get a credit card, get some information about what each credit card does and how is it going to benefit you the most. So let's say you travel a lot, 2 or 3 times a year. Maybe a rewards point credit card is going to help you because you're going to accumulate a lot of points every time you travel and then you can redeem them. If, let's say, you're a person that carries high balances on their card and cannot pay them every month, maybe a low interest rate card is the one for you. Maybe you do a lot of purchases and cashback is important to you. So meaning at the end of every month, you're going to get cash back from what you spend based on a percentage. Maybe that card's important for you. So something to always think about. If we go to the next slide, now we have personal loans. So personal loans are more for a major purchase or something that's long-term. So you want to buy a car, you're going to school and you need a student loan, or you're gonna, you're going as a family on a trip and you don't have enough money to do it and you want to finance it. These are some of the things that you want to consider when you're considering a loan. So minimum at RBC, for example, a loan starts at $5,000. So any major purchases that's over $5,000 is when RBC will consider giving you a loan. And then anything less, usually you have enough credit card limit to do it. This is where you would use it for those purchases. Secured, it depends. So let's say you're purchasing a car, your loan might be secured because the bank will guarantee the loan with the car. So let's say, for example, you're unable to make payments or you stop making payments on those loans, the bank has the right to take your car from you. and that will help with the risk itself. Also, for example, here it doesn't say, but from a long-term perspective, most of the time people get a loan to buy a house, and under personal loan it will be called a mortgage. But these are long-term major purchases that we're going to use to help you finance, a big purchase. So usually the term of the loans are 1 to 5 years. There's always exception that can go a little bit higher, but for example, a mortgage can go up to 30 years, again depending on what's important to you and what you need. Interest rates usually are around 5%. Again, when we talked about savings account and now we're in a very low interest rate environment, interest rate can go down to 2-3% on the loan, but also can go up to 10%. And when we talked about good credit, again, depending on your credit, if your credit is really good, you might get a 4% loan. But if your credit is really bad and you're high risk to the lender, you might get a 10, 11, 12% loan. In terms of payments, you can schedule payments based on what's important to you and how you can make payments. So it could be weekly, bi-weekly, monthly. Usually I recommend, if you're getting a loan, make the payment the same way as you get paid if you're working. So if you get paid monthly, do it monthly. If you get paid bi-weekly, then do it bi-weekly, because it's just easier to keep track. If we go to the next slide, and we fill up, yes. So a line of credit is a little bit different from a loan because it's kind of a flexible credit that you would get. So a line of credit is something that is a revolving credit facility, meaning that, let's say the bank gives you a $10,000 line of credit. What that means is the bank or the lender gave you a limit of $10,000 where you can spend any way you want. So if you don't spend it, the line of credit is there. And if you do spend it, let's say you can use as much as you want. You can use $1,000 up to $10,000 up to the limit. And then you have flexibility on payment as well. So you can pay it, all at one shot. You can pay it, on a monthly basis, or every time you get a bonus, or whatever it is. And then the nice thing about the line of credit versus the loan, let's say the bank gives you a $10,000 loan, they give you, the full $10,000. You have to make payment until the balance is zero. Once the balance is zero, your loan is gone. It's closed, and you don't have access to it anymore. Versus the line of credit is revolving. So again, they give you $10,000. You use $10,000, you pay it back. Now you have $10,000 available again, and you can continue on using it until you need it that other time. So that's really the difference between the two. The nice thing about it, and what's really used, the purpose is emergency funds, or let's say you fell down, you're broke, I don't know, you need to go to the emergency, but for whatever reason you have to pay and you don't have enough money, you can transfer money into your account from that line of credit for that. Or let's say you have family in another country and there's an emergency and you had to go, but you don't have enough money, you can use that line of credit as an emergency fund to really help you with that. Usually line of credits, in terms of payments, the lender will only charge you interest on a monthly basis. So if you borrow $1,000, it's up to you to make that $1,000 payment back. But the only responsibility of the lender is to take interest payment every month to make sure that credit facility is still revolving. Now, if we go to the next slide, we're going to talk a little bit about credit score. So, it's really important for you to understand and to have access to your credit score. Now, I'm only talking about RBC because I don't know what the other banks do. But if you do have an RBC account, when you log in on your online banking, you have an option to say view credit score. And then it's free, it doesn't cost you anything, and it doesn't affect your credit, to just going in there and taking a look at what your credit score looks like. So if we go to the next slide here, the credit score is really about how living your best life really means, and the opportunity and the responsibility that you have to do to ensure that you have access to good credit. So when the lender gives you money, we look at 5 things. So we look at your character. So how responsible are you in managing your finances and taking responsibility for your debt? Capital. How much money do you have in your bank account and saved up in terms, let's say, you're not working anymore or you're unable to pay. Do you have some savings aside to be able to pay for that debt or for those payments? Capacity. So capacity is really important. So usually what we look at is your income versus your debt, and we're looking at that 40% ratio. So if you have way too much debt, sometimes you don't have the capacity to get more money, because again, we want to put you in a good financial situation. Collateral. So we talked about security, right? So is there anything that we can use to secure that debt? For example, the car, the house, when you're getting those big purchases. And then the last thing, which is the most important, is your credit history. So your past behaviors and the credit that you already have, and how well you're managing it and how well you're paying it. So if you go to the next slide, if you do, for whatever reason, pull up your report, your summary on the credit report shows your name, your address, your social insurance number, your credit cards, loans, how much money you owe, and if you're paying your bills on time or if you're being late on paying those bills. So make sure, from a fraud perspective, not to share all that information, your name, your phone number, your address, your social insurance number. Be careful on what are the information that you share, because sometimes you can compromise yourself where people can use your information to borrow money on your behalf. If we go to the next slide, and then just click one more time to show the graph and more. Perfect. This is a little bit of what that looks like when you, again, just from an RBC perspective, go to your credit score and look at your financial reputation and what number you score. So obviously, the higher the number, the higher the score. If people can't see this on the screen, an excellent score is between 790 to 900. A very good score is between 725 to 759. An average score is between 660 and 724. A poor score is between 560 and 659. And then just starting out or failing is 300 to 559. So, and sometimes you might log in there and you might see that your score is low, not because you have a very bad credit. It's just that you don't have credit at all. So for example, if you're starting out, this is your first credit card, you might not have enough credit to build that history. So in order to really build that history, try to get your first credit card. Try to get a line of credit whenever you can, or if you need some money for your student loans, try to get that, so then you can make payments on time and you can really starting that to build that credit. Another thing that's important is your mobile devices. So for example, TELUS, Fido, Rogers, whoever those providers are, when they give you a cell phone or an iPad or whatever, they report this on your credit bureau. So your monthly phone bill, don't ignore that. If you don't pay it, it's going to affect you poorly on your credit score. So every month, make sure you pay your bills on time. Even for whatever reason you have a dispute with those providers, make sure you still pay it, because if you don't pay it, it's gonna affect you negatively. And then once you pay it, you can resolve it with them. But as long as you have those payments consistently, I know that we've had to deny a lot of people credit because of those small bad credit behaviors that they have with those specific providers, and not with the big ones. So their credit cards are paid on time, their loans are paid on time, but then that specific thing is not paid off time. And sometimes we ask them, okay, what happened? And their answer is, oh, I didn't want to pay because they didn't give me the best service, or they overcharged me, or whatever. Well, I understand, but this is affecting you in a negative way. So something to really, really keep in mind. If we go to the next slide, there's two credit bureau agency in Canada. So we have Equifax and TransUnion, and these are the two credit bureau reports that you would get. So sometimes there's things that show up under your Equifax report but don't show up on TransUnion report, and vice versa. And the reason for that, it just depends on where the lender uses. So for example, for RBC, we mostly use TransUnion. But because we're a big lender and we're a big financial institution, we make sure that both credit reports are reported correctly. But there's a lot of times where one thing shows up on one report and another thing doesn't. So making sure that you're keeping track on those credit reports. Again, you can access them for free if you do have a bank account and online banking. If you don't have an RBC account, you should check with your financial institution to see if there's anything on their end. If we go to the next slide, this is just a little snapshot of what that looks like for you. So if you go to the RBC online banking, this is what it's going to show you on your credit score, and then the score simulator. So it's going to give you all your accounts, your information, and making sure that that will help you. And then let's say, for example, you add a credit card, you just want to play around with it. It will tell you by adding a credit card for this amount, it will improve your score by this much. Or adding a loan for this amount, it can improve your score, or sometimes it might reduce your score for this much. Okay, so if we go to the next slide, quickly here, just showing you what are some of the things that makes up your credit score. So there's your credit history, your credit utilization, your credit application, your credit variety. So if all your credit is credit cards, sometimes that has a negative effect on your credit history versus having, a loan, a credit card, a mortgage, a car loan, and all of those things. Obviously, the account history, and sometimes having too many credit products can negatively affect your credit score. So making sure that you only have product that you need. So let's say you have 5 credit cards. Sometimes that might have a negative effect on your score. So do I really need those 5 credit cards? What's most important to me? What can I get rid of? Also, let's say you have a credit card for $10,000 and you go over that limit. So you spend something for $100 more. So now you're $10,100. That will also negatively impact your credit score. So making sure that you never go over those limits. And if you do need to go over, you pay that balance before you make a payment. Okay, so if we go to the next slide, we're going to quickly talk about how to build good habits. And I know we talked about it a lot, but if we go next, and next again, perfect. So let's say good debt and bad debt. Some good debts could be, education. So getting a student loan, getting a business loan, getting a mortgage. Some of the bad debts, and not all of them, but when you have too many credit cards, or you go to those small lenders that are going to give you payday loans. So they'll give you $1,000 and charge you 30% because, you cannot get a loan at a big bank. Sometimes those are bad credit. Or if you do cash advances on your credit card because you don't have enough credit and you're going over the limit. So these are all things that you really need to consider. And then the last thing on the slide here, if we go next, is really around building good credit with good habits. So if we go to the next slide. So things that you need to consider, pay all your bills on time, reduce your debt. Sometimes let's say you go to your credit report today after this session and there's some errors. You need to contact, Equifax or TransUnion to make sure that they correct those errors. Use your credit card responsibly, right? Because again, if we use a lot of money on the credit card and we're unable to pay, then we're just paying interest over interest, and that can really affect you negatively, because eventually you won't be able to pay it. And then obviously starting early. So starting as early as 18, as soon as you turn 18, you'll be eligible for a credit card. Go to the bank or talk to your parents and say, hey, I really need to start building my credit. And, it could be as simple as getting a $500 credit card or $1,000 credit card, just to help you get started slowly. Or if you're in school, getting a student loan or a student line of credit. Even if you might not use the full limit, at least it's there, building rapport. So the last slide is just me thanking you and seeing if there's any questions. I feel like I talk too much, so hopefully you were able to absorb all of that. There was a lot of information, but that's really the basic on what's important and how we can help you be ready for the future and achieve financial success.
Thank you so much. Yeah, we're ready to open the discussion. If anyone has any questions, don't hesitate. I know we have one in the chat already. We can start with that one. You guys
so the question in the chat, it just says, how accessible is the RBC online banking website?
Yeah, so that's a very good question. The RBC online banking is very accessible. You can access it anywhere, and it has a lot of information and resources. So even if you're on your phone and you don't have the app downloaded, you can go to your browser and really log in easily to the online banking, and you can mostly do everything. Between paying bills, transferring funds, sending money to your friends via e-transfer, sending money to another RBC client if that's possible, sending a wire transfer overseas. If you do have investments account, you can open them and buy, sell, whatever you're looking for. Accessing your credit history, like I said, lots and lots of feature and resources that can assist you. Hopefully that will answer your question, Thomas.
Are you aware of if any like reading softwares, anything like that, work on your website specifically? Are you aware of that side of things?
Sorry, what do you mean?
Just for people that have like visual disabilities, sometimes they use reading softwares that actually read to them. It's a little bit of a technical question, but
I don't know, but I can find out.
Okay, perfect. Thank you. Is there any other questions?
Yeah, if there's any questions, feel free to either speak up or you can put it in the chat and we can read that for you as well.
I have a quick question here. Maybe you can clarify we talked a little bit about the savings and the checking. Can you clarify the difference between those two accounts? Why one has like pays you more, higher interest than the other ones do?
Yeah, absolutely. So the checking account has no interest at all. And the reason for that is because it's only the purpose of that checking account is just to use it for your everyday use. So let's say, again, you're working or, you got an allowance, you put that money in there and you're going to use it to pay bills, going to purchase whatever, anything you need for that everyday banking. So it's not designed to put money aside and earn interest, and that's why it has no interest. The savings account is the one that has interest. Again, lower interest than if you're willing to invest over the long term, but it helps you a little bit to just put some money aside in case you need it in a week or in 2 weeks or in a month, or you need to pay rent, for example. You can put that money on the side so you know that you don't spend it. So these are designed that way to kind of help you organize yourself as well.
Awesome, thank you.
I'm also just being mindful of time, so we're scheduled to finish around 8:30. So maybe we can take one, maybe two, but for sure one more question. If anyone has anything they want to bring up, now's your chance.
I know I was very detailed, but you never know.
Yeah, well, through the whole presentation, I kept thinking of questions I could ask to get more in depth in the subject. And the next slide, there it was. Awesome.
I guess I have a question.
Sure.
So definitely, like the information that you spoke of, I'm assuming it's you can still generalizable to different banks. I'm just wondering if you can explain the difference between a bank and a credit union.
Yeah, absolutely. So in terms of products and services, a bank and a, oh, what happened? You guys still hear me?
Yeah.
Okay.
Yeah,
perfect.
we still hear you.
I'm seeing something different on the screen now. And
No, I just shut off my camera so nobody would cut out.
Awesome. So yeah, like I said, a bank and a credit union, we mostly have the same products. The only difference between a bank and a credit union is that on a bank perspective, we're kind of a larger organization. So usually credit unions are more specific to, let's say, a specific province. So there's like the Alberta Credit Union, there's the Montreal one, really specific to that area. And then let's say you're a client that's relocating to another province, you won't be able to take your account with you because it's not as big as the big banks. The other thing between banks and credit unions, and that's more technical, but again, from a product perspective, you guys can get, anything you're looking for from any lender, is more on how the credit union is structured, is that the people in that credit union, they're called members versus clients. So they kind of contribute to the profits of the union itself. So I think they share some of the dividends, and they have a little bit more voting rights than the clients itself, if I'm not mistaken. But in terms of going to credit union versus a bank, it's really your preference. And it's really about, do you think you're going to be relocating in the future? So if you're going to stay in Ontario, for example, forever, really there's no difference. Sometimes in terms of lending, the big banks have better lending capabilities because there's more availability and we can take higher risk than the credit unions. But if, let's say, you're a person that switches provinces all the time or travels a lot, stays in a specific province for maybe 2 weeks, 3 weeks, and needs to go to the bank and access money, it becomes more and more difficult. So I think that's the main difference for you guys from a client perspective, what you'd be looking for.
Perfect, thank you.
Yeah, that was good. If we don't have any more questions, I'm going to ask one more. But, okay. I don't think anyone has any questions. We always see those ads in those companies that give out offers, like they say $200 for only $20. Can you talk about those and what are the implications? I'm not sure if you understand what I'm trying to go for.
Yes. So these are exactly, I think what you're talking about is the payday loans, right? $200 for 20.
Yeah.
So basically, and we talked a little bit about that in the bad debt perspective. Not that it's a bad debt, but it's a higher risk debt. So $200 for 20 is because most people go to those payday loans because they need money right now today. And at the bank, they can't get it right away because they need to go through the application process and the credit process. But most of the time, those small payday loans, they charge very high interest. So $200 for 20, what is that, 10% of interest? And, there's a lot of terms and conditions for it. So it could be per day, it could be per week, depends on what that looks like. And then if you don't pay it with a specific time frame that they've asked you, then they probably charge you more and more. So you have to be really, really careful when you're going to those payday loans, reading the terms and conditions and knowing for 100% sure that you're going to be able to pay it at that specific time, or else, it's going to get accumulated and it's going to turn badly.
Awesome. Thank you. Danica, do you want to wrap this up?
Sorry, just before we end,
yeah.
You do see my name on the screen, Nibal Yamout. If you guys want to connect with me through LinkedIn, if you have, one-on-one questions that you have, I'm happy to help and to share my expertise. Again, this is just, we talked quickly just about, basic banking, but there's a lot of more information that, if you guys need, I can be happy to provide.
Perfect. Thank you so much, Nibal. We really appreciate you coming and sharing your expertise. So like we said, this was the first of a 6-part series. So our next session will be held on February 25th, once again at 7:30. And at that time, we'll be speaking about taxes. So also a very important finance topic. So we hope that you can join us. And for now, we wish you all a good night.
To learn more about the CNIB National Youth Council, visit cnib.ca/NYC.